Hello, welcome back guys. In this video we're taking a look at Apple. Now we're going to be taking a look at a lot of tech companies, so I'm going to be making separate videos. So if you're new around here, you may want to subscribe. There's going to be a ton of new videos coming your way. So if you're interested in adding new stock to your portfolio, especially since 2023 is about to enter the premises, it is a good idea to become a subscriber. And also please like the video if you enjoy this kind of content. Now, we're going to be starting with Apple. We're going to be taking a look at Apple here, which is a company that has been dropping significantly in the past couple of weeks. As you'll see here, this is the 1 month chart. Back in, let's just say November over here, December 2 that is, over here, it was actually, it closed at 147, so it's down quite significantly since that time. But since it's 1 year high, it's actually down about 30%. Now, it is a company that is obviously fantastic, and everybody is looking to get a great opportunity here, a great price. Is this the price? This is what we're going to be examining in this video. The company has a P ratio of 21, and you will see that it has been dropping and dropping a lot, so it's getting cheaper and cheaper. It used to be 35 or around over here, and it keeps dropping and dropping. Now, the price to free cash flow is even lower. It's sitting at 18.4, so even if this is denoted as red over here, this happens automatically by our software whenever the value is less than 20. But it definitely depends on the company as well, because not every company is the same. If we're looking at a company like Walmart, 21 may be high. But for a company like Apple, it's not high at all. And you have to take a look at the other financials just to see what is going on with the company. And you will notice that their price to free cash flow is even lower, as I said earlier, lower than 20. So it is a green over here. Plus, the company is buying back a ton of shares. And as you can understand, the board is not, they're not stupid. So they're buying back shares for a reason. And they would be buying back shares only when the company was cheap. They wouldn't be buying if it was expensive, or at least an intelligent board wouldn't do that. And Apple doesn't have a reason to do unintelligent moves. They have tons of money, tons of executives. They are smart with their moves. And they have bought back a ton of shares over here, 20%. And they keep buying, so they are not stopping now, which is a great thing here. You see that if you buy the stock today, for instance, you probably get a discount just because Apple is buying back their own shares, basically making your stock worth more because they're going to be retiring some stock from the open market. Now, the total liabilities of the company are very low as well, which indicates that the company is very solvent. Obviously, this company is making tons of free cash flow. They have insane amounts of money in their coffers, so they're very, very solvent here. And even though they are a beast, they are a huge company, they are up 50% in their 5-year revenue growth. So they are still growing like crazy over here, and their net income is also growing quite a ton. The free cash flow too. And it's only the total equity that's going down, but that's for a reason. They are actually doing it on purpose. I have filmed a separate video in the past, like a few months ago, in which I'm talking about why this is happening. I'm going to link to that at the end of this video. So after you are done watching this one, if you're interested, you can take a look at why Apple's total equities growth is going down instead of going up. And it has to do with a return on equity pretty much, which get inflated via debt, via cheap debt, I should say. But it's a good sign here for the company. The margins of the company are also pretty high, 25% over here, and they are looking fairly solid in this few past years or so. And as you'll see, the company is paying a little bit of a dividend, 0.8%. That's very little. So it's just a slight dividend here when you compare it to the free cash flow that the company generates, about 15%. So you can obviously always use our tool here and take a look at, the stock analysis page, the dividends tab. And you will see that the Apple has been paying a dividend that they usually keep increasing, but it's not like it's the kind of dividend that you would expecting every quarter, and you would expect more and more and more. It's a little bit of an extra here for Apple. But Apple is mostly a growth story here. It's not so much about getting the dividend. It's not, even though it's a huge company pretty much and an established name, they are still growing. It's a tech company. And usually we can use our dividend discount model, but not with these kinds of companies. Here it doesn't make sense because you would want to use it for companies that dedicate their free cash flow to dividends, and that's not what this company does. Okay, let's go back and take a look at the financial statements. Remember, you can take a look at what I'm doing here and basically do it with any stock by becoming a Patreon. The links are in the description box below this video, and obviously you get full access here, and you help support the channel too. Okay, so $265 billion in revenue back in 2018, right now 400 billion in the fiscal year 2022. So an insane amount of extra money pretty much being printed by Apple in terms of the revenue, making it tons more in terms of the revenue. And what about their net income? Also increasing their net income at a very, very nice pace, 59 billion to almost 100 billion over here. So the company keeps increasing their net income, which is fantastic to see. In terms of the balance sheet is the thing that I talked about. They are actually dropping their total equity here. Again, a separate video. Take a look at it at the end of this one on why this is happening. It's by design. It's not that Apple is actually losing equity. They're actually doing it on purpose. So the cash flow is the next thing that is very, very important here, and you will see that it keeps increasing in terms of operating cash flow here, 77 billion to 122, which is fantastic. And if you take it down to the free cash flow, which is the adjustment after paying for capital expenditures, pretty much after the company pays for their capital expenditures, what is the free cash flow that they are generating is 64 billion over here, that is back in 2018, and right now $111 billion, which is great. And you can see that their capital expenditures are about the same every year, so they are basically organically increasing their free cash flow for the most part. And you will see also the adjustments. They are paying a little bit in stock-based compensation. That's how tech companies operate in the Bay Area. That's very, very prevalent over there. Depreciation, amortization, very usual stuff. And as you'll see again, the company is increasing their operating activities cash flow by net income, which is exactly what you want to happen, not by adjustments or sales, one-offs and things of that sort. Now, we want to take a look at our stock evaluation tool pretty much, which will give us the stock evaluator, the DCF model, which will give us a price for the company, a price to pay today for the company. What does it make sense to pay for a company that is generating this kind of free cash flow here? Now, the revenue growth of the company has been achieving in the past few years. The 5-year average has been 12%. The 3-year average has actually been better, 15%, and last year was 7.7%. Obviously, there is a little bit of a decline in the overall markets lately because of COVID, because of the lockdowns. The whole activity pretty much has been brought down. And so this is why you are looking at a little bit of a decline over here. And if you take a look at what analysts are saying about Apple, they are indicating that we could potentially see something near 2 to 5% for the revenue growth of the company in the upcoming 1 or 2 years. Now, this means that we want to use a low value here just to see what's going to happen if the company does 2% for the next 5 years, and what about 5%? However, you have to recognize that if you have a couple of, let's say, a couple of years where the whole economy goes down, Apple makes less revenue, they don't grow their revenue that much. There tends to be some economic expansion after these years go by. Because when the economy gets suppressed for a while, then when things go back to normal, there tends to be economic expansion. The Fed will actually lower interest rates, so people will actually be spending more. So it is then when companies tend to increase their revenue quite significantly, and you could see, let's just say 3 years where Apple does 2%, 3%, and 5%, and then the 4th year they do 20% in terms of their revenue growth, pretty much effectively making an average of maybe even 10%. Depending on what they do. So you can understand that this being a 5-year average, you have to kind of try a few different values, and it really makes a ton of sense here to try something like 2, 5, and 8, or even 10 in some situations, based on the fact that the company has also been doing 12% and 15% in the last 3 years. So these are, for the most part, very conservative values to begin with. So remember that. This is important. And of course, you can use the tool and try your own projections here and see how that affects how much you should be paying today. But it's worth recognizing that. In terms of net income margins, the company does the same thing, 23, 24, 25 is what they do. Again, we could always bring it down a little bit if we want to be more conservative. I think these numbers already here are a little bit conservative to begin with. In terms of the free cash flow margins, the company does about 110%. We're going to go 100, 105, and 110. And 13% for annual return is what I typically like to use. You can kind of see the free cash flow margins here are typically above 100%, so just 1 year, 98. Okay, and we hit calculate, and over here you will see that with these kinds of projections here, our current price being at 128, we're almost there for our high projections, which is, remember, 8% revenue growth. This is not out of the question, for sure, definitely not. And the medium projections are sitting at 102. With the current price of 128. But remember, you have to recognize that not every company is the same. So it does make some sense to be paying a little bit of an extra for companies that have a great moat. They're making fantastic margins. They have tons of money in their coffers. They can expand their operations whenever they want to. Great executive board and everything. They're buying back shares. There's a lot of positivity here, a lot of positive signs. So paying a little bit, a little bit more for a great company is, much better than paying too little for a company that's average. So if you are looking to open a position at Apple, it may be a good idea to potentially at least average down a little bit if it keeps going lower. Now, of course, you could wait. You don't know what's going to happen, but by waiting, you could potentially have a run in the markets where Apple, in 2 weeks is like 140. Who knows? Nobody really knows what's going to happen. But if you take a look at our projections here and what the company has been doing and what we're expecting it to do in the upcoming years, I think even 128 that the company is at right now is a pretty solid price. It's a fair price. It's not cheap, but it's not expensive either. I'd say it's about fair for a company like Apple. Obviously, I'd love to get it at 110, for example. That would be great, or 100 even. It would be even better. But even at this price, again, beginning to average down, it may make sense to buy a little bit of Apple. Again, recognizing the fact that this has a lot of positive things behind it. It's not just the free cash flow model, which obviously is super important, but it's not the end all be all. Thank you for watching, guys. I hope you enjoyed this one. And remember to watch the video that I talked about earlier. It's the one that talks about how Apple is actually artificially, they do it on purpose, they actually decrease their total equity in order to bring up the return on equity figures, which are now sitting at about 160%, for example. So why are they doing that? How are they doing it? What does it mean? Take a look at this video and you're going to find out. And I'll see you soon. Have an awesome day and a great year. I'm going to see you in another video before that. But thank you for watching. Bye-bye.